Hey folks, so in this video I'm going to make the case why we should be bracing for lower lows in risk assets and equities more specifically. And while we're going to look at this through the lens of some structural stuff, there's also obviously technical reasons for it. So we're going to go through both things. I do think both are important. Before we look at that though real quick, it is that time of year again right now for really the best bar none online education event out there. It's absolutely free, so don't worry about it. And I actually join it every year, not just as a speaker, but also to actually listen to a lot of these presentations, as many as I have time for. And so what you want to do is you want to go over and register for the Wealth 365. And if I wouldn't believe in it, I certainly wouldn't be promoting it. But I would certainly highly encourage you, and I really mean that, to go there. You're going to learn strategies. I honestly learn something every single time. There's a lot of different speakers. It will not waste your time, I promise you that. I will be talking there as well about a strategy that we are deploying right now in the market, so you guys can listen to me there as well. But do yourself a favor. You're going to sign up. You're going to get a lot of free stuff as well, a lot of free resources. So by all means, please go ahead and sign up there. But let's talk a little bit about the case for lower lows in equity. So we're going to go through a couple of things, and we're going to start off with what is the consensus right now. And just so you know, for perspective, consensus oftentimes doesn't work in markets. So when everyone thinks the same thing, or at least parts of the crowd, then it usually doesn't happen. So what you can see right now is that there's a really strong consensus that the equity market is going to bottom in the month of April. It doesn't say it can't happen, but the consensus is very high, which usually means it doesn't happen then. So I'm more in the camp of this happening maybe at some point in May, maybe a little bit later on. And that doesn't mean that we have to go straight down forever between now and then. It means we're going to have choppiness. So that's for some perspective. And I hope, again, if you guys have questions on this, by all means, leave a comment down below. But here's where it gets really interesting. And what I'm going to show you guys right now is probably not something you can hear of a lot of different places, but this is really, really important. So let's have a look at this chart, which is very simply a chart of something called credit risk, like basically implied default risk. It's really specifically what this points to. And you can see that the risk of default in a lot of different sectors, here we're looking at consumer discretionary, consumer staples, energy stocks, financials, and healthcare, has risen sharply. And it hasn't risen this much for the most part since the year 2008 into 2009. So this is really a different environment than we've had for the past decade, and I'm trying to make that very clear. Right? This is the number one topic that I explain to our clients, that this is really a situation where credit risk is once again on the table. And so what we tend to see, and we'll look at the chart in a minute, is that certain parts of the market are more levered than others. So for example, one of the reasons I'm so bearish on the Russell 2000 small cap stocks is because of this one. This is a chart that I just found this morning, but it's the easiest one to show you as well. And what you can see here, if you want to focus on this black line, that is the Russell 2000 small cap stocks. Basically, what it's showing us is that small cap stocks, they haven't been levered this much, like have this much debt, which they could potentially default on, which is the point of the previous slide, in ever. Right? It says your leverage is becoming a bigger issue for small caps. Now, we could certainly have some large caps blow up, but I think in the small cap spaces, that's a big deal. So if we now go just our typical S&P 500 centric view, here's usually how this tends to play out. So you have sort of three different stages, and ultimately, if you go back further, in a bigger sense, you have four stages. But let's just look at the move down we've had recently. We had the initial phase lower, and you started to have shock phase kick in somewhere around early March. I think initially people were just kind of, on alert, but a lot of people here, believe it or not, after the first 2 days, we got a lot of people basically emailing us it's time to buy, and a lot of people unfortunately did. Not necessarily our clients, but people we hear from. So we had the shock phase, and we're still kind of going through the shock phase. We've had an initial relief bounce, oversold bounce, because things were technically very, very oversold. And what's now going to happen most likely is we are going to get another leg lower. Now that leg lower may not be as clean, for lack of a better term, or sort of non-stop as the first move was, But it's probably going to happen as economic news starts to deteriorate. Everyone knows we can have horrible data. You know, we can have negative GDP growth. We can have horrible unemployment, which we already know. But I think what's now going to happen, we're going to hear more defaults. You know, and companies really telling us about how badly things are. Some big companies or notable companies are going to go out of business, and the whole debt problem starts to become, you know, a headline thing that we just can't get out of for a while. And that's really the main reason why I think we have more downside. From a technical perspective, just so you guys know, so far, and this is very simple technical analysis, but I'll quickly mention it anyway, because every time I do one of these videos, people ask. From a Fibonacci retracement perspective, we have retraced 38.2% of the initial leg lower. So from this move to down here, we've now so far retraced 38.2%. Now, I will warn that it's probably going to be choppy here. I would not be surprised if we even go as high as a 50% retracement before we ultimately move lower. But again, it's not just a technical case here. This is a technical case, and I'm here to show it because everyone will ask me for it. I think the bigger point is the previous two slides. Another question you're probably asking is, well, how low could we go? And here, there's really two things we need to focus on. We need to focus on what's realistic and what's a worst case. In my personal opinion, a worst case would get the S&P 500 over the course of probably the ensuing months somewhere towards 1,600 to 1,800. There's a lot of support. There's a lot of reasons why. There is technical reasons, things like Fibonacci retracements, things like big picture. If I show you this on a monthly chart, you can see if you get down to that area, maybe a little bit above, you get a complete retest of the majority of the bull market. So there's reasons to believe that that's possible. I only assign about a 20, maybe 25% chance to that, right? More realistic and probabilistic, in my opinion, this is just my opinion, is that we see something around 2,000 as we have another lower low, right? And that lower low could be very short-lived, right? So that's kind of how we're looking at it. Also keep in mind that we're still in the shock phase. We're going to have the news get quite bad from a corporate news perspective. Of course, we have to get through the corona peaking first and all that stuff, the curve. But ultimately, we will have a rebound in economic activity. But I think it won't be V-shaped. We'll have a V-shaped recovery to a certain degree, and then we'll probably flatline for an extended period of time, maybe up to a couple of years. So that's what I'm seeing here, folks. I hope this is helpful to you. Again, if you are interested, I definitely would highly encourage you to sign up for Wealth65. Again, it's a free event. You get a lot of free stuff with it. They even have a charting platform and stuff like that. So go ahead and sign up there. And I will see you there too. I'm going to be speaking as well. See you soon.